Hello, welcome back. So I'll be ranking my portfolio stocks based on a few things. I'll be ranking them based on valuation, based on disruption risk, based on growth for the company, as well as the order that I'll be adding to my stocks. So these are the stocks that I have in my portfolio. I have Meta, MSCI, Microsoft, Mastercard, S&P Global, Amazon, ASML, United Health, Google, as well as Visa as my core positions. And the first stock on this list is MSCI according to the ranking. So MSCI year to date is down around 5%. It's currently trading at around a 38 times earnings. So what exactly does MSCI do? MSCI, what they do is they have their index portion of the business. So you have your MSCI Emerging Markets Index, MSCI Global Index. When you buy those indices, MSCI will make a money off for the index itself. And for MSCI, the great thing about the business is it operates in an oligopolistic environment. So there is no risk of regulation here, especially since MSCI only holds around 25% of the entire market share. And for MSCI, the great thing about the business is this. So MSCI has secular tailwinds. So as you can see from 2007 up to 2022, the assets under management actually grew by around 12% CAGR all the way. And it is expected that it will continue growing this way as well as people shift from active investing to passive investing. So for MSCI, this is basically a guaranteed 12% return for the company itself in the index portion. It is incredible how a company can grow like this. It is incredibly predictable for this company to continue growing at this rate. So for MSCI from a valuation standpoint, over the past 5 years, the company has never traded at a lower valuation than it is today. So the price to free cash flow today is around 29 times. And over the past 5 years, the lowest point was in 2019 when it traded to around 30 times earnings. So you're not paying an expensive price for MSCI today. I think a 28 to 29 times price to free cash flow for a quality business like MSCI is a reasonable one to pay. Next stock is S&P Global. So for S&P Global, the stock is currently up around 4% year to date, currently trading at a 40 times earnings. So for S&P Global, this is their business model. So the crown jewel for S&P Global is their ratings portion, where they have a duopoly with another company, which is Moody's, as well as the indices portion, where they have the S&P 500 as well as the Dow Jones indices. And they have other portions of the business as well, which is highly predictable, all of which are data businesses. So you have your market intelligence portion, you have commodity insights, as well as the mobility portion. So for S&P Global, there are clear tailwinds for the business as well. So around 45 to 50% of their net income actually comes from the ratings portion. So for the ratings portion, the debt level and the debt wall is projected to increase all the way until 2028. And couple that with the lower interest rate environment that will be going in the near future, S&P Global's rating portion will be able to grow at a much higher rate as compared to what it has grown over the past 2 years. So for S&P Global, the other portion that is incredible is their indices portion. So similar to MSCI, this company has this indices portion that will grow 10-12% every single year. And it is a highly predictable and recurring business model as well. And that's why S&P Global is a high quality business. And from a valuation standpoint as well, this company is currently now trading at around a 28 times price to free cash flow. I think a 28 times price to free cash flow is reasonable for a quality business like S&P Global. Next stock is Amazon. So Amazon year to date is down around 3%. It's currently trading at a 34 times earnings. So for Amazon, the potential for the business is limitless. So if you have to look at the technology and infrastructure portion, which is their R&D, Amazon had R&D of 88 billion last year, and you compare that to Google. So Google had around 50 billion worth of R&D last year. So if you were to just adjust Amazon's R&D to levels of Google's, then that is easily around 30 billion more on the bottom line already for Amazon. So for Amazon, if you were to play with the numbers, 30 billion more in terms of their operating income will lead to around a 50% increase in their operating income itself. So for Amazon, it is a company with great potential. If the management wants to pull the lever and basically intentionally lower their reinvestments into the business, you could easily see this company growing EPS by 50% just in 1 year itself. So for Amazon, the valuation makes sense as well currently. So the stock now is trading at around $214, and assuming a 28 times earnings, if Amazon grows at around 15%, this company will give you around a double-digit return already. Assuming Amazon grows at around 20%, then you will double your money in 5 years' time. So for Amazon, it's a high quality business. I think it is one of the better buys in terms of your Max 7 today, and that's why Amazon is third on this list. The fourth stocks on this list is Mastercard as well as Visa. So Mastercard year to date is up around 5%, Visa around 8%. So for Mastercard and Visa, they're similar to S&P Global and Moody's in terms of the ratings portion, and they also act as sort of like a toll booth in the global economy. So the global payment volumes have been projected to grow around 16% from 2023 all the way to 2028. So the increase in payment volumes itself will immediately translate to increase in the top line for both Visa and Mastercard. And for Visa and Mastercard, they have incredible fundamentals as well. So if you have to remove this portion, which was the COVID pandemic, this company has grown revenue almost every single year, at around 10, 12, 15% or so. So for Visa and MasterCard, I'll be adding them at these prices. I'll be adding Visa at around $295 a share, and I'll be adding MasterCard at around $500 a share. Hopefully they get there soon with all this stablecoin chatter, and these companies, they are the fourth on this list. Next company is Microsoft. So Microsoft year to date has crushed the market. It's currently up around 17% and is currently trading at a 37 times earnings. So for Microsoft, it is a bulletproof company. So they're basically a conglomerate at this point. They have all these different products under them. And for Microsoft, it is incredibly hard for your enterprises to switch out Microsoft products because of all the data that's being tied behind of it. And if you're to compare that to consumers itself, consumers could easily swap from Google search to maybe ChatGPT, whereas for Microsoft, your enterprises and your companies, they can't simply just do that. So for Microsoft, the problem with the stock today is simply just the valuation. So it's currently trading at around the 37 times earnings. And over the past 10 years or so, this is one of the historical high in terms of the valuation. So for Microsoft, it is in the 5th spot simply because of valuation concerns. I think the company is trading at a premium valuation today. But over the long term, this is one of the buy and hold forever companies that I'll have in my portfolio. The 6th stock is ASML. So ASML year to date is up around 15%. It's currently trading at a 31 times earnings. So for ASML, the business is just selling of machines, your EUV as well as your DUV machines. They hold the greatest market share in your DUV segment, around 80% or so, and they hold 100% market share in the EUV segment. So for ASML, the problem with the business is the China risk itself. So it is impossible for you to predict when China will come up with an EUV alternative, and that could shake up the entire lithography space, and it's impossible to forecast and predict when China will come out with this product as well. So ASML currently holds a monopoly in EUV, but if China can come out with an alternative that is lower cost, higher yield, then it could pose as a challenge to ASML. And the other portion that is risky for ASML is also its dependence on AI. So for ASML, almost all of its growth currently is from the AI segments. So if AI turns out to be a bubble, then this will hurt ASML earnings in the future as well. And that's why it's in the 6th spot. I think the company is a high quality one with an installed base that is growing, but it is in the 6th spot because of the risk itself. In my 7th spot, I have 2 stocks. I have Alphabet, Google, as well as Meta. So Alphabet is currently down around 10% year to date, and then you have Meta, which is up around 18% year to date. So for Meta, it is probably one of my weaker stocks in my portfolio. They are cyclical in nature, and 100% of their revenues coming from advertising is risky as well. So the valuation is high historically, it's trading at around 27 times earnings. And for Meta, it is currently growing like a startup company is growing revenues at around 16 to 20%. It is impossible to predict whether or not they're trading on elevated earnings. But when a downturn comes, there's no doubt that Meta will be hit the most out of all these different Max 7 companies as well. The next stock is Google. So Google is probably one of my riskiest stocks in my portfolio. They have regulation risk, they have innovation risk, and they have structural risk as well. So for Google, they have the DOJ lawsuit in August. That will be the settlement. If the judge forces Google to sell that Chrome portion, then it will be almost lethal to their business. But if nothing comes out of that one, then this will be bullish for Google. So it's highly unpredictable. And the other portion is their earnings as well. Their earnings next quarter will be critical as well, especially the search volumes. So the Google page views have been dropping over the past few months. In fact, over the past 2 years, ever since ChatGPT came out. So this is a number that investors will pay attention to, and this could signal a weakening of Google's moat if they continue declining at this rate. The last stock and the most speculative one that I have in my portfolio is United Health. So United Health year to date is currently down around 40%. It's currently trading at a 12 times earnings with around a 3% dividend yield. So for United Health, the dates are here for the important events. So on July the 3rd, they have the Medicare fraud settlement issue. And if nothing comes out of that, then that could be bullish for United Health. They have their earnings coming up on July 29th as well. I expect the management to lower their guidance by quite a fair bit to lower the expectations of investors. So historically, the healthcare insurance space is a very hard industry to invest in because of all the risk associated with it. And so for United Health, it is currently now a small position in my portfolio because the company is risky, it's a valuation play, and it is unpredictable in nature as compared to all the different other stocks in my portfolio today. Last portion, I'll be covering some questions left in the comment section. So the first one, it says, would love your thoughts on Constellation Software. So I was listening to a podcast on Constellation Software. What they do is they buy and they acquire recurring revenue software businesses that are extremely small. So normally for businesses like this, it is incredibly hard to predict because acquisitions itself is risky in nature. But the CEO, which is Mark Leonard, has executed to perfection. The shareholders have been rewarded favorably over the past few years. But for Constellation Software, I think it is a company that is trading at a premium valuation. So I don't expect the returns to be as great in the future as compared to in the past. But for Constellation Software, their CEO is almost Warren Buffett-like. So if you have the stock, I think this company is a high quality compounding machine that will continue to increase intrinsic value over the next few years. Next one, it says, what do you think about Vinci? Mode like toll roads and airport concessions, irreplaceable physical assets, forward price to earnings of around 14 times now, 10-year median 16 to 17 times, cheapest point since 2020, traffic volumes are at all-time highs while inflation-linked tariffs reset upward each July. So Vinci is a company that I've looked into as well. I was also looking up another company, which is Ferrovial. Ferrovial is a company that is owned by Chris Hone. So similar to Vinci, Ferrovial, they do a build, operate, transfer business model. So they built the toll roads, they operate it for a concession period of around 60 years, and then they transfer it back to the government. Vinci does something similar as well. And yes, irreplaceable assets is actually one of the most overlooked and neglected modes out there. And for Vinci, I do agree that it is a high quality business that Wall Street is neglecting today. I hope you guys have found this one useful and invest safe.